25 basis points? Is it in line with tapering QT? I think just trying to understand the reaction function on the balance sheet and rates, and at different levels, right? I think at 5.5, it's easier for them to start to cut, and becomes a little harder as they get those rates down closer to 3%. But I think that's going to be the focus, just trying to understand that reaction function today.
Priya, it's off your remit, but we saw ECI finally lighten up a little bit today. We got a jobs report coming up on Friday. Where are we going to be Monday morning?
There's a lot this week. It's a very big macro week. But I think the jobs report will be an important number, both the average hourly earnings and the number, to get a sense of, is the labor market slowing? I would say the labor market tends to be often a lagging indicator. So if policy is restrictive, we think things are slowing. Whether it shows up, I mean, it's a noisy number. Whether it shows up on Friday or not is harder to tell. But I think, what's the message from the Fed today? Are they open to normalizing policy, starting the process of normalization? How is the economic data? What's the fallout of New York Community Bank? Is that one bank that needs capital? Or are there these problems across the regional banking system that the market starts to fret about? We've got this new wrinkle, which is actually not such a new wrinkle given what we lived through last year. And remember, the BTFP program runs off. So this cheap funding that banks had runs off in the middle of March. And so does the discount window start to get used? So there's a lot. Come Monday morning, we'll be looking at the banking sector, the economy, and then trying to assess, is the market pricing in the correct Fed reaction function?
Well, Priya, I'm glad that Tom went there to all of the things that can happen, because we've been seeing just narrative shift after narrative shift. And earlier this morning, we had several guests on who are talking about how the biggest risk is actually a reacceleration of inflation later this year, whether it's Wei Li of BlackRock or whether it's Sebastian Page of T. Rowe Price. All of them have the same fear. What are you seeing that makes that less relevant if people are looking at the strength in every single outlet, regardless of, yes, one pocket? What are you seeing that gives you confidence that we should focus more on New York Community Bank Corp, more on certain weakness and some peripheral indicators?
So maybe it comes from my thesis that monetary policy is restrictive, because I look at long end real rates. I look at the fact that the balance sheet is shrinking. So, we talk about easing financial conditions, but it should be viewed, it's context dependent. It should be viewed relative to where the economy is. If inflation's at 2%, yes, financial conditions have eased, but they haven't eased to the point where they start to become accommodative. If we were in accommodative territory, absolutely, there's reacceleration of inflation risk. I think we went from very tight financial conditions to less tight financial conditions. Monetary policy is still very restrictive. So where does that inflation reacceleration come in? Now, I'm watching wages. I was nervous before ECI because it's been running higher than average hourly earnings. And if that number had come in 1.2 quarter over quarter increase, okay, then it's a little nerve-wracking because our wages not coming off. Wages are coming off, rents are coming off. A lot of the higher goods inflation is already in deflation. So when I look at service inflation, I don't see signs of that re-acceleration unless the Fed goes crazy and goes to like 1% in the near term, which is unlikely. They're cutting slowly, methodically. So we really need easy conditions, I think, for that re-acceleration. I don't see those easy conditions here.
Hey, Priya, great to catch up with you. Priya Misra of JP Morgan Asset Management. 2 minutes out from that Fed decision. It's interesting the way we started the conversation this morning and how it's developed as we've approached this decision. The conversations we had this morning, Bramo, Chair Powell's going to be non-committal in this news conference. What we heard from Matt Lazzetti at Deutsche Bank is that they've got to set this up in the statement and then in a news conference going into March and maybe beyond.
And people earlier this morning were saying maybe that's going to be a mistake because there is this strength that could cause inflation to reaccelerate. Now people are saying, get on it. Why don't you cut now? Because basically you're getting a green light with signs of things being pretty tight.
I think the green light here is the markets are on the move. To have Priya here on the Fed decides it's really key to get up front. I wish she was in the press conference asking her own questions. I got a 171 10-year real yield. That was unimaginable, John, 24 hours ago.
We'll catch up with Mike McKee in 60 seconds. 60 seconds away from that decision from the Federal Reserve. Here's the state of play in financial markets at the moment. In the equity market this afternoon on the S&P 500, we are lower by 0.7%. On the Nasdaq, we're down by 1.1. 171. I did not think we'd be talking about New York Community Bank and the bond market today, but we are. Lisa, Treasury yields lower by 10 basis points at the front end to 4.24.
And how many people have said community banks are fine, they're successful, they're not going to fail, they're not going to show cracks. New York Community Bank comes out and has a loss and suddenly cut rates sooner because that's basically a sign the stresses are getting too great.
Just shows that people are still on edge about this issue.
100%. I think people have not realized whether you've seen the shoe to drop, and commercial real estate is still a very big question mark, particularly in certain urban centers.
The 10-year yield down by 7 basis points, 395.77. Just to finish on foreign exchange, the euro looks a little something like this against the dollar. Euro-dollar at the moment, 108.47, totally unchanged. With your Federal Reserve decision, here is Mike McKee.
Risks to the economy are now balanced, the Fed says, and they're no longer talking about raising rates, but do not expect cuts soon. No change in rates today, and the statement drops the reference to additional policy firming, now saying, quote, in considering any adjustments to the target range, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. But before you buy March futures, the statement goes on to say, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Officials say the economy is solid, job gains remain strong, and the committee judges that risks to achieving its employment and inflation goals are moving into better balance. Inflation, however, has eased over the past year but remains elevated, the statement says. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. There's no change to balance sheet policy, nor does the statement suggest any changes are imminent. The Fed will keep the $60 billion cap on Treasury roll-offs and the $35 billion cap on mortgage bonds. The decision today, unanimous. And one other bit of business, the Fed has extended its tighter policies on investment and trading to senior staff and any staff with access to confidential information.
Mike McKee, thank you, sir. Let's get to the price action immediately and look at equities. Equities on the S&P 500 just a touch lower by almost 1% on the S&P. On the Nasdaq, we're down by 1.4. If you just turn to the bond market briefly, yields were lower by about 10 basis points to the front end. Now 425.61. That moved face just a little bit. So, Lisa, let's go through what we got here. We've dropped the tightening bias, but not a full embrace of the rate cut conversation taking place on Wall Street.
And there's a little bit of disappointment clearly that you can see on the front end with people maybe thinking they would lean into a March rate cut, saying not thinking anytime soon, highly attentive to inflation risks. That focus may be casting a bit of cold water on some of the hopes and dreams.
The TK down 5 basis points on the 10-year, just short of 4% here at about 3.98.
Coming a little move here, John, and I still say we're radically different from where we were earlier this morning, or even days ago. Yes, we've pulled back a little bit. It'll be interesting to see the press conference, to say the least. This is well timed. Joining us now is Richard Clarida. He is with PIMCO, their global economic advisor. He's the former vice chair of the Fed and far more associated forever with his Columbia University. Richard Clarida, Ethan Harris, student of Columbia, ex-Bank of America, wrote a brilliant piece off his hero at Columbia, Phil Kagan, the other day, and he said, we've blown it on our inflation studies. We've got to get on trend. And for him, the trend is the Dallas Trim Mean, the Cleveland Median, and the rest of it. What is the trend right now, Professor Clarida, in inflation?
Well, thank you for having me on, Tom. Good friend of Ethan, and Phil Kagan was a colleague and a friend for many years. I look at Dallas Fed trimmed mean too. It's running somewhere in the mid-2s on inflation. That's down a lot from a couple of years ago, but still obviously somewhat above the Fed's long-run goal of 2%. But I think that's a good reading right now.
Rich, when you look at the pushback, and it is subtle pushback in this statement, why do you think this Federal Reserve is not quite prepared to fully embrace that rate cut conversation taking place on Wall Street?
Well, on this one, John, I actually agree with them. I myself, looking at the data they're looking at, would have thought March would be too soon. We don't get a lot more data in March than we have today. Moreover, as you've pointed out on air, and I've been watching, there is still some upside risk on the inflation picture. So I just think good policy prudence would call for getting more information. And I applaud what they did in the statement today. They did I don't have it in front of me. I read Mike's account. Looks like there's a lot of red ink in it, and I think that made sense today.
Yeah, especially with that particular comment. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. I'm wondering, Rich, do you think that the New York Community Bank Corp issue changes the equation, even on the margins for the Fed, and if you were on the Fed, for you?
Given what I know right now, Lisa, I would say not, but I do think that the reality is that we have a number of regional banks in the U.S. Above 100 billion, but not in that mega category. And the Fed did what it needed to do last spring, and I have no doubt that they will be there if further is needed. So I'd say right now this doesn't appear to me to be systemic. But whenever banking is involved and you see an unexpected loss, it certainly is on their radar, and I'm sure it is.
Rich, as